Recording in progress. So by the way, I hope you all don't mind that we're recording this session. We're doing that for the people who had expressed interest in joining, but who are not able to be here today. So let me share my screen and we'll try to share with you what we have lined up for today. Can we all see this? Great. So I think the bottom line of what I'd like to say is that I think many of us end up far more intimidated by the nature of financial planning and investment than we really need to be. I think that it's relatively, it's a bit simpler than it seems. And I would liken it to the fact that you can eat healthily without necessarily being a nutritionist. You can get the exercise that you require without being a physiologist or understanding kind of human anatomy. And in the same way, we all have the capacity and capability, I think, to learn how to invest our own money without necessarily entrusting blindly others to do that for us and entirely on our behalf. And that's my encouragement to all of us is that I think after even maybe 10 hours of just thinking about things and reviewing some of the basic math and principles, that we might all have a better state of peace of mind about our own investment and financial future. Yeah, and I think what I would say is, and what I have learned from my own experience is that if you are intimidated by something, you will be debilitated by it, which was the situation I was in financially. I didn't think I could get my head around how to invest money or what would happen to money that was invested or how that all worked. It just seemed so complicated and beyond me. And that ended up, that lack of belief in myself, I think, ended up in me being in a very sad situation. But that's over. So moving forward. So what I think we'll cover in the next several weeks, maybe 4 or 5 or 6, depending on how things go, is the following. What's different about us as expats? So we had thought about making this course focused on expats, and not all of us in this call are expats, and I think that's fine. Most of the principles don't change, but there are some things that are particular to those of us who don't live in the countries that we come from, that I will mention early on. Then where does money come from? That's an important thing. And then the time value of money, which is the basis of investment and how money grows over time. Later, we'll talk about compounding interest, an introduction to investing and what we mean by investment. We'll talk about asset classes, planning for the future, doing calculations, understanding how the financial markets actually work, and then what we mean by asset allocation, diversifying where our money is invested, and then how to make and stick to an actual investment plan. I think, yeah, the first 3, the ones that I put in boldface, are what we can probably cover today. And hopefully we can all manage about an hour and a half together. By the way, if there's anyone who has any interjection or a question to make along the way, please speak up and let me know. Okay, so let's just start with a bit of an introduction. Let's talk about the cost of advice. And many of us have received financial advice. And by the way, this course and these few lessons are not going to replace the value that you could get from good financial advice, which we should all consider getting when we need it. But often what is marketed as advice is actually just a sales pitch. So let's look at the following scenario. So imagine we have 2 people, Arnold and Beatrice, and each of them decide to invest $1,000 every month for 20 years. And both of them are investing in the same market, so they both earn the same return, gross return of 7% before the fees that they pay. And let's imagine in Arnold's case that he signs up for something which is similar to what I signed up for, where he charges the investment firm that he is engaged with charges 1% fee on the funds that he deposits and an annual fee of 1.5% on the assets that are under their management. And at the same time, Beatrice is a do-it-yourselfer, so she invests in low-cost ETFs. We'll talk later about what those are. She pays nothing to deposit them, and the expense ratio on those assets is 0.5%. How does their wealth grow and change over time. So each of them has invested at the end of 20 years the same amount, which would be $240,000. But then what would they have by the end, and how much? Can anyone guess? Anyone? The answer is that Arnold's going to have a lot less than Beatrice, because that 1.5% and that 1% are going to add up quite significantly. So in the early years, you won't notice the difference very significantly, but because these changes, because the difference compounds itself year on year on year, the Beatrice pulls away from Arnold at an increasingly fast rate over time, particularly later on. And so at the end of the day, or at the end of 20 years, actually, Arnold ends up with $448,000, but Beatrice ends up with $549,000. And I think this difference is obviously significant. So Arnold has almost doubled his money, but Beatrice has done quite a bit better than that, and actually ends up more than $100,000 better off than Arnold, and not from having invested in some amazing stocks or having chosen something that is remarkably profitable, but rather simply by watching the amount of fees that she is paying to the advisor who is ostensibly providing advice. So that's one thing that, by the way, that being able to perform that calculation and understand that is one thing that I think at the end of these few weeks together, all of us will be able to do. Another thing is this, which is calculating what we expect to be able to save for retirement over time. And as we sock money away over time, we know that what we have put away will increase based on the amount that the returns that we are getting on our investment. At the same time, we know that, or we could expect that as we grow in our careers, we might be able to continue to invest more over time, because we'll be making more money, ideally, as we get more experienced and older. And at the same time, we know that the power of the money that we have will actually decrease. So $1,000 that we have now, in the future, $1,000 bill, let's say, will buy less in the future than it will buy now. So we need to take all of these various pieces of math into account as we plan for the future, and say, the money I'm putting away will grow based on the returns that I'm getting, but at the same time, the expenses that I have will also become more expensive because of the power of inflation. And if we all look at our lives and say, I'm at a certain point in my career and in my life, and I want to work until a certain point, or I want to work until I have a certain amount of money and then want to stop, what are those points, and how can we expect that wealth to grow, and how much can we expect to have when we get to that point? So this is kind of looking forward at where I think we will be at the end of our time together, and something that I would expect everyone will have the ability to do. And I think that will also provide a bit of peace of mind to everyone who's here with us. So that's thing number 2. And then thing number 3, I think, just looking forward, is that we will all be able to understand how to track where we are as we go, and what is our investment portfolio, what does that look like at this point in time. And I think it can be rewarding after a number of years if you track this type of graph, saying, this is what I own in stocks, this is what I own in real estate, this is what I have in cash savings. It becomes a virtuous cycle if you start tracking this type of thing, and 4 or 5 years from now you realize that you've made great gains. I think that will encourage all of us to continue. So let me stop there and ask if there are any questions before we get started on any of the material.
Just a quick question about expected rate of return. So Arnold gives 2.5% to this active manager, and we get market return. That doesn't seem like a really good deal, right?
No, not if you can get that return without paying that person that money.
Yeah, I mean, the point is, like, so Beatrice is not engaging anybody. It's more like an ETF, broad spread, no investment, no effort. But then you have somebody actually managing the money, but they can't beat the market. So we're assuming that the market is the best return that you can get. You cannot, like, beating the market is basically whatever the financial advisor says is kind of hogwash.
Right. That's you're 3 weeks ahead of us, Kazi. That's entirely true. And you're 3 weeks ahead of us. So we're going to come to that in a little bit, where we talk about, like, is that person, whether are you getting as much or more out of that person than they are charging you? But that's entirely right. Yeah. Anybody else? All right. So let's just take a quick moment to look about what happens to those of us who are from one place and who then go to work in another place. There are a number of things that change in life, and I think we see the good ones and we don't always see the bad ones when we move overseas. Sometimes, I mean, usually people leave for a reason. Often that reason is money. So occasionally you'll find that people leave and they end up making more money, and sometimes they have better benefits than they would have had at home. Otherwise, they probably would have stayed. You may be living in rented housing, which means, of course, that if, it may be the case that your employer pays your housing, it may not be, but regardless, you're not paying down a mortgage and you're not building equity in a house. You may live outside of your country. And for me as an American, if I were to work in the US, I would have access to Social Security, and I would be paying into a US based, like a 401k, which is an investment in a retirement savings account. And when you live overseas, you don't have the option to be involved in those things, which can give you more cash in the short term, but in the long term, it means that when you go back home at 65, they may look at you and say, well, sorry, we have nothing for you in your Social Security account, and you're not getting anything, which means that the onus is on all of us to sort out for ourselves our own futures, and not rely on what the government might have been able to provide had we stayed at home all of these years. Another thing is the issue of domiciles and tax liabilities. So if you're in one country, and if you're working in another country, and if you own property in a third country, and if you're married to someone from another country, you might find that you suddenly, what had been simple in terms of submitting tax returns becomes rather complicated, and you have to think about where you are reporting all of this information and where you are paying tax on your earnings, and how you're managing to try to avoid paying double tax on anything that you make, etc. And from personal experience, again, the poor financial regulation in the new country, and I think particularly people from the US and the UK who end up going to places like Mozambique, for example, realize that it's a bit of the Wild West, and suddenly anyone who registers a business can provide any kind of advice on finance or insurance and that kind of thing. And you have a bunch of cowboys running around ripping people off, and the regulatory environment is not really well enough developed to prevent them from doing that, or to get after them when they have committed crimes. And so you really need to look out for yourself. You can't really rely on, people being nice. Healthcare is another issue that you might end up paying for yourself, or you might end up, if you end up sick or having to pay for something out of pocket later on, that can be a different thing that that might be more disadvantageous than had you had that issue in the country that you're from. Another issue for many expats is the issue of a so-called trailing spouse. Trailing doesn't sound nice, but it means, like, if you are working somewhere and if you're the one who's making the money, you may have your partner may be the one who is has come along with you for your career, and while you might be the one, let's say, financially better off for having gone to this other country, you may have someone else who doesn't have the same job opportunities, and the net result for you and your family might not necessarily be positive, because you have one person making more money, but the other person who doesn't really have the opportunity for good work. And then you have all of the temptations of living overseas. So it can be the case that there's so many more new things to do and places to go and restaurants or whatever, that there's all kinds of things to spend all that more cash on, and you don't really feel very inclined or interested in thinking about the future when eventually you will have more expenses and things you actually have to pay for yourself, and potentially no social security or whatever. None of those safety nets to help you out at that point, which means that, again, the onus is on all of us to think in the future or in the present about what the future is going to look like. So the goal that I have here with this, and thanks for giving me the opportunity, is really to give people and all of you the basics of what it means to, of what we need to know to invest intelligently. And that doesn't mean stock tips or get rich quick schemes or any of that. It's really around the fundamentals of how money works, how wealth can grow, what the difference is between various types of investment, and then how we should diversify portfolios, and how we can calculate how our expenses will be in the future and how our wealth can be expected to grow over time. So it's more about a bit of math and discipline and calculation and understanding than it is around some rich dad, poor dad type of get rich quick business. Frank is back. By the way, each situation is different. So one thing I'm not providing in this is actual advice. You need to go to a fee-based financial advisor for good advice that is relevant to your situation. We're talking here about principles and how things work. And it's your own situation and how taxes work in the places where you live and want to work eventually are up to you to sort out and to understand from someone who can provide advice based on a fee and not based on a commission for something that they will then sell you, would be my recommendation. All right, so what is money? First, it's important to review this. Money is a medium of exchange. We all know that. We all exchange money every day. Money has its own value. It is not tied to any asset. So when you talk about things that we exchange with other people, we have money, which, everything we determine the value and we articulate the value of various things in terms of money, but money itself is not really useful for anything other than buying other things that are valued in money, in terms of money, which means that the value of money depends on our belief and other people's belief that it actually is valuable and that someone else will accept it in the future. And then just to take a step back and maybe just a bit more philosophically, it's important, I think, for us all to reflect on what we think of money as being, whether it's a means or an end. And I think, many of you I've known from my social or professional network. We're all involved in international development and that kind of thing. And I think most of us understand that money is a means to how we want to live. It's not really an end in itself. So the point of life is not, of course, to amass tons of wealth, and greed is, I think we can all agree, an evil thing. But at the same time, having money and not being broke and not allowing other people to run off with our hard-earned savings or the returns that can be earned from those savings is also something that I think we would agree is really valuable and will allow us to achieve the goal and the purpose that we have in life more easily than we would if we were kind of busy getting screwed over, if that makes sense. So money won't make us happy, we know that, but at the same time, not having money is also really annoying. So anyway, that's that. So where does money come from? Let's look at this, and this is a bit of an example. Now, there are rules set by central banks in various countries around the amount of money that, once it's been deposited in a bank, can be loaned out to people who go to the bank and look for loans. So let's go through a bit of a story, and that what we're using in this case, an example of 10%. So we're saying that if we have a bank and someone deposits $100 in that bank is required to retain capital of 10% of that in deposits, and the rest it can loan out. So if the bank has $100 from someone who came with a deposit, the bank can give out a loan of $90, for example. And then that money re-enters the economy. So this is an example based on that parameter of 10%. So we're pretending that these are the people in this economy and that this is 1 week. So we look at Monday, and on Monday, Alice goes to the bank and she puts $100 in her account because she had a $100 bill somewhere and she decided that she wants to store that in the bank, which she does. On Tuesday, Beatrice goes to the bank and she takes out a loan for $90. And the bank, of course, that's the most they could loan out because they had to retain that $10 based on the central bank rules. So Beatrice goes and she buys a car with her $90 and she gives that money, her $90, to the car dealer who puts $90 in the bank, which you see now here. So the car dealer has put a deposit of $90 in the bank. And on Wednesday, someone named Diane goes to the bank and she asks for a loan because she wants to buy a mule. So she goes to the bank after the bank retains $9, which was, again, that central bank requirement. And the bank loans her $81, which is the most they could. And Diane buys that mule from someone named Enrique. And Enrique goes to the bank and he puts $81 back into the bank. Are you with me so far? So on Thursday, the bank keeps $8.10 in reserve and then loans $72.90 to someone named Frederic who wants to buy a lawnmower. So she goes to Frederic goes to the garden store and she deposits, she buys the lawnmower, she gives them the cash, and then that store puts $72.90 in the bank, which you now see here. So on Friday, of the $72.90 that that had been received from the garden supply store, the bank keeps $7.20, which again is the rule, and then makes a loan of $65.61 to Gordon, who will use the money to buy bean seeds. So Frank has sold the seeds to Gordon and then deposited $65.61 in the bank. Now, on Saturday, after all of that weeks of economic activity has taken place, Alice and the car dealer and Enrique and the garden supply store, or the owner, and Frank decide that they want to get together and start a business. And they're going to take the money that they have all deposited in the bank out of the bank, and they're going to start their business. So the question I would put to all of you is, how much is their starting capital? And more importantly, is their starting capital more or less than $100? Any hands up for more? Any hands up for less? I don't see anybody. Some chats, more than 100, more than 100. So where did that money come from? That's the right answer. So these people have $409.51 together. But the question is, where did that money come from? Because that money all started from Alice, and Alice went to the bank with $100. And somehow all of these people have deposited $409 in the bank. And if that money had kept going around, even more and more money would have been there, created. Where does that money come from?
It comes from the splitting of the loan. So like you're creating money out of thin air. No?
Yeah, where thin air is also called credit. Yep.
Exactly.
That's exactly right. So a lot of people think, and it's important to remember that many people think that money comes from, that loans, for example, would come from deposits. So someone has gone to the bank, they put money in the bank, and then someone else is going and taking that money back out. That's not entirely true. It's more true that the deposits that exist are the result of loans that have been created in the past.
I just have one question. If on Saturday you have Alice, car dealer, Enrique, supply store, and Frank withdrawing all the deposits. Now, does the bank have that money to pay that money?
No,
I mean,
they
that
don't,
sounds
they don't
like a
have the
run of the
cash, do
bank.
they? There's, that
No,
cash
no, so
doesn't
they-
exist.
Okay, yeah, okay.
And
cool.
that's what
Yeah,
happens
that makes
when,
sense.
this is called fractional reserve,
Okay.
or capital requirements. And so it's, the bank can loan out more than it actually has in cash. But that's also why there is more money in the economy than there are dollar bills anywhere, right?
Yeah.
The money exists in that we all own it, but the cash has not really been printed. So it's a bit of a mind-bending scenario, but it is how things work. So takeaway number one from this first bit is that money, this thing we think about as money, is created when commercial banks issue credit. It's not that money, that there's just so many dollars in the world and we're all fighting over how we're going to get them. Does that make sense? Ish? Yeah. So then,
So this is basically, we're talking, a bank has a ledger and they're just keeping the tabs, right? So they create the credit, and on the 5th day, they just create another account for these 5 people that account has extra money, right? And then it just goes all across the cycles. This $405, right?
yeah, well, this is just an example, right? But the point is that it's just an example, but the point is that the more times people take a deposit and then make a loan out of it, the more money can be created in the economy.
Thanks.
But obviously those loans have to be paid back. And if those loans don't get paid back, then there are other issues.
Sure.
All right. So now we're going to talk about that. That was just kind of for fun, to help us understand how weird money is and how hard it is to actually understand. Now we're going to talk about the time value of money, which is I think the meat of today's discussion. So let me ask a couple of questions. First, which is better, $100 today or $110 tomorrow? And maybe I will ask us all to put in the chat which one we would prefer. So someone says 100 today, someone says 100 tomorrow, someone says $110 tomorrow. So who can give us Johanna says $100 today. Johanna, why would you rather have $100 today than $110 tomorrow?
Well, again, this depends on many scenarios, but let's say you put it, you have somewhere that you can put it, like say a property that you know will do well today, and you don't know, there's also, I guess it depends on your immediate need, and say you have an
So I mean,
investment
by
today.
tomorrow, I mean like Sunday, like the day after today.
Okay, if it's tomorrow, then I would rather have the 110 tomorrow, because it's 10% return on investment.
Overnight.
So yeah,
sorry,
okay,
I don't know. I guess tomorrow's like the
I was thinking
indefinite
tomorrow in
future,
a year, but like literally tomorrow, then yes,
talking
I
literally
would rather
tomorrow.
have it tomorrow.
Okay. Does anyone still think they'd rather have $100 today than waiting 24 hours for a 10% return? Nobody. Okay. How about oopsie. How about the next question, which is $100 today or $101 a year from now? And now we're saying we'd rather have $101 today. Why is that, Lewis?
I think in the next, if you add $100 in the next year, I think the value of what that money can buy in the next 1 year will be much less, maybe due to inflation.
Okay, okay. So we all agree that, does anyone have a different view? Would anyone rather wait a whole year to get a 1% return? Doesn't sound like it. And the question then is, what makes the difference between, a 10% return overnight or a 1% return over a year? And that word that you mentioned, Lois, is exactly the right answer, which is inflation. So inflation is the thing that gets at all of us. And it's the rate at which cash or money loses its value over time. So that brings us to the point of this chapter, which is the time value of money. We all know that money, well, maybe we don't know, but I'll tell you, money is worth more the sooner that we get it. So having $100 today is worth more by some degree than $100 tomorrow or $100 at any time in the future. It's just a matter of how fast that money will lose its value, which is the question of inflation. So the definition of inflation is a rate, which means that it's a degree of change over a period of time. Inflation is kind of two things. It's the effect that causes purchasing power to fall, but it's also the rate at which prices increase and the value of currency falls. So in the first one, we would say that this is an effect. We would say there's a ton of inflation going on in Zimbabwe, and that's why the dollar is now, $1 billion in Zimbabwe currency is not worth anything anymore. And the second part of the definition is an actual rate. So we can talk about inflation as a rate. And for the purpose of this course, we will use something between 2 and 3%. I think in all the calculations I've said 3%. That's maybe a bit high, but it's also a bit standard. That's something that I think is typical for the US and Europe. In other countries, it can be quite a bit higher. The actual percentage, I think, that we use for the purpose of the exercises doesn't matter. What does matter is that we are consistent and that we not disregard the effects of inflation on our money as we have it. So yeah, again, the same mantra is that $1 today is worth more than $1 tomorrow, or $1 at any time in the future, which also means that money is, the sooner you get money, the more valuable it is to you if it's the same amount. The second definition or principle that we want to talk about in the future is the so-called discount rate. And inflation is a rate and an amount that we can all agree on based on economic activity, whereas discount rate is something that we choose. So we choose in order to take into account the fact that money will lose value over time. We establish a discount rate for the future value of something. And this might sound complicated right now, but as we go over it, it will make more sense. But the point is that we have to establish some way of understanding how fast things are losing their value over time. And from the exercise we did at the beginning of this part, where we said, okay, overnight 10% return is really good, but over a year, 1% return is not very good. The discount rate would be the point at which the breaking point between those two. Like at what point how much is a dollar worth a year from now, in whatever terms we want to use, would be determined by the discount rate. More on that in the future. So it's the rate used to calculate the present value of future cash flow. So what is the number that makes purchasing power equal, let's say, between now and the future? And generally, and then for the purposes of this exercise, we will use the inflation rate, because we will want to know, for example, if we're buying something in the future, how can we make sure that the amount we're paying for it, the amount that we expect to pay for it, is likely to be the same as we're paying for it now? This might be confusing, so let me stop here and see if there are any questions. Okay.
One question. So currently the interest rates are quite low. In the UK, it's almost zero. In the US, it's almost zero. So how does that play into in terms of discount rate?
That depends on what type of discount you want to do. So if you're discounting because you're looking at how investments will grow, then you need to use that government interest rate. That's the risk-free rate, right? To use that as your baseline in comparing various investment options. That's one thing. But if you are discounting the value of a future expense or return, then you would probably use the inflation rate, right? So let's say, for example, you want to use, let's say, for example, you're renting out an apartment and you know that in 10 years, it will rent out at $1,000 a month. You need to use a discount rate to come back to how much that will be worth today, right?
Okay, so it's like looking future cash flows in present terms. Inflation is current in future terms.
Inflation would be used for your expenses, whereas if you're talking about interest rates being low in a particular country, that would mean that the cost of capital is low and would mean that as you are that your risk-free rate is also very low as you're comparing various investments.
Okay.
But it's like, and that's why there are two ways of using a so-called discount rate, because you are either discounting investment returns or you're discounting, let's say, a future return or a future cash flow, whether that's positive or negative.
Okay, thank you.
So let's use an exercise and say that if something costs $100 today, how much can we expect it to cost 3 years from now if it keeps pace with inflation of 3%? And what is the value today of an asset that will be worth $1 million 10 years from now, assuming that it will also appreciate at the rate of inflation, which again, we're just using 3%. And unless someone would like to wager a guess, we can walk through how this will work. And in order to come up with these, the answers to these questions, I guess, there are two formulas, and they're both based on the same math. So they're reciprocals of one another. The first one is establishing the future value. So the value of an asset at some point in the future is something that we want to know and to understand. So what is the future value of a one-time investment of $1,000 invested for 20 years at 8% interest? Figuring this out does not depend on anything other than basic mathematics, right? So we can calculate this and figure it out. And the way to do that would be this way. So we start with the amount that we have right now, and we multiply that by 1.08 for every year that we leave that money invested, which means we are essentially multiplying 1,000 times 1.08 times 1.08 times 1.08 times 1.08 until we've put that 1.08 in there 20 times. And then we come up with the actual figure, which is $4,660. And the way that that's done, and this is going to be an important formula for us for all of the other things that we calculate going forward, is with this, which is the future value formula. So we take the present value, or the present amount that we know we have, times altogether 1 plus the interest rate to the power, or to an exponential power of the number of periods that we will leave this invested. And here that is in kind of shorthand. And I'll just mention that it's important that you do this, the second part of the equation altogether first. So 1.08 times the power to the power, and then multiply that times the present value. So this formula, we'll practice this in a minute, but that's the important thing. And then the reciprocal of that formula is similar, but goes the other way. So what is the value in today's dollars of an insurance payout of $10,000 that we know we will receive 7 years from now in the future? And the way to figure out this is, in the previous version, we multiplied, and here we divide. So we take 10,000 and we divide by 1.03 to the power of 7. And if you do that math, we have $8,130. And the way we do that is by this, I mean, this is the manifestation of the present value formula, which you can see is division instead of multiplication, and puts the present value by itself outside. So the future value divided by 1 plus the interest rate to the power of the number of periods that something remains invested or earns those returns. And here in shorthand again. There are some notes on that, but that might get a little bit confusing. Let me ask now if there are questions or if we're kind of understanding how that works.
Yeah, I mean, we are assuming that the money doesn't grow. The money is not added back to the interest. The interest is not added to principal over the 20 years, right?
It's adding. It's adding. It's being in. That is why. So if you look. So the fact that this 1.08 is multiplied by itself is adding that every time to the next stage of the arithmetic, if that makes sense. So 1.08 times 1.08 times 1.08 times 1.08. And that is how this becomes, by definition, exponential. And because it does that, it adds more and more every time it adds, every time it multiplies. Let's say it's not adding, it's multiplying.
Okay, thanks.
Does that make sense?
One question, Daniel.
Yeah.
If you have an interest rate of this 8% and you have an inflation rate of 3%, do you cross them out against each other?
You would, so that's where we're going to go with the retirement planning bit. So
Okay.
if you have the, you don't cross them out in terms of the actual dollars that you are earning, right? So let's say you have $1,000 and you put that away and you're getting an investment return of 8%. At the end of a year, you'll have $1,080. And at the end of the next year, you'll have a little bit more than additional $80 to that because it's compounding on top of each other, on top of itself, right? Then to understand how that money you will be able to spend that money, you will need to reduce your purchasing power by the amount of inflation that you can expect in that economy. So if you are, if your investment returns, let's say, are 2%, but inflation is 3%, the amount of money in your account will grow, but your purchasing power will actually decrease because you are accruing returns at a rate that is less than inflation. And you're getting
okay.
more money, but it's actually becoming less valuable, and you're actually falling behind.
Right.
So here are these kind of sound like riddles, but they're not. So the present value of an asset will increase in value at a certain percent is equal to its current value when the interest rate and discount rate are the same. That basically means, like we said, and Ugo, that goes to your question. So if inflation were 3%, and if you were to get 3% returns on your investment, that would mean essentially that that money retains its purchasing power, its value, even though it might be worth more in dollar terms, it would still only have the same amount of purchasing power because everything else around it is getting more expensive at that particular rate. So if an asset increases at a rate greater than inflation, then the present value of that asset will be greater than its current price. And what this would mean is that, and this is I think the important part about investing in something, is that if you're investing in something that's earning a 7% return, and if inflation is only eating away at your pot of money by 3%, then over time you are outpacing inflation by a return of 4%, which will also mean later on, we'll also see that if that's the case, if you have 3% inflation and you have 7% returns, that would also mean that you can harvest 4% of the amount of money in your account kind of by having without really affecting the amount of money that is there and from which you are earning the return. So that's kind of in the principle of an annuity or an endowment. And then an asset that will increase at a value less than inflation can have a net present value that is less than $0. So this would mean, if I give you an example, if you are going to sell something, let's say you're going to pay $100 for something, and you know that you can sell it for $101 a year from now, even though you can expect to get $101 in that amount of time, the net present value of that investment is negative because it is less, the return on that is actually less than inflation. Is that mind-bending, or does that make sense? Any thoughts? All right, so let's move to an example. Let's say that in 10 years from now, we expect to sell a house for $500,000. What is the value of that today? If we assume that there's a discount rate of 3%. And as another question, what is the net present value of that decision if we know that we'll have to pay $495,000 for this house today, assuming that there are no other cash flows associated with this purchase? And I've put here in how that can be figured out in Excel by using the formula that we discussed already. So the future value, the present value formula is the future value divided by 1 plus the interest rate to the power of the number of periods. And if we've said that we know that $500,000 is the amount of the house, and we will discount it by 1 plus 3%, 10 times, because that's 10 years in the future, then we come, and here I've done the same math in Excel, leaving here the formula. So it is 500,000 divided by 1.03 to the power of 10, that's $372,000. So assuming that all other things being equal, inflation is 3%, you could say that having $372,000 today is equivalent and equal to having $500,000 10 years from now at this rate of 3%. And if you say that you have to pay $495,000 for that house today, again, this goes back to the example we spoke about earlier, that if things, if the returns that you get on your investment are less than inflation, then you could actually have a negative present value, because it means that you're kind of wasting money by owning them. And that would be the case, that would be the situation for this house purchase. So because you could essentially put $372,000 in the bank today and let it get 3% interest. This would mean that this home purchase would essentially cost you $123,000. Does that make sense? Any thoughts? I'm not sure. All right, so let's move forward.
I got one, Daniel.
Yeah.
Where is a bank that you can find that's giving you 3% interest at the moment on your savings?
Yeah, that's exactly
I guess that
right.
depends where you live, because that's a challenge that I've been facing anyways. But which then for expats would potentially affect this calculation as well.
That's exactly right. And we would be assuming, in this case, we would have been assuming that, and probably incorrectly, that the savings and the discount rate on that would have been the same. But you may be right that just parking that cash would not give you a 3% return, which would change your change the equation quite a bit.
Just to add, wouldn't it just say that investing in a house is a bad call? I mean, you can invest in a bank, you can invest in bonds, you can invest in stocks. As long as your net present value is in the positive, you get to win. I think, isn't that what we're kind of getting at?
Yeah, what we're kind of getting at is that just because you own something and just because you spent money on something, if it doesn't earn a return, either because it generates cash flows or because you can resell it later at some amount, at some higher amount, that it's not necessarily a good investment. Even if the purchase price is lower than the sales price eventually in the future.
Exactly.
Right. Yep. That's the point. That's the point. And the other point is that we have to understand which discount rate we will use when we make those calculations.
Hey, Daniel, I have a question.
Hi.
Would you be able to go back to the previous slide? Yeah, this one. So this one, what you're saying is, let's say if you buy a property at 372,000 and then you sell it, then 10 years down the line, if the discount rate is 3% and if the value is 500,000, then if you sell it at 500,000, then you're basically just kind of like break even, so to speak.
Yeah, and it goes, I mean,
Because,
you have to, there's the assumption there that Johanna also mentioned that the returns that you would get are 3%, the same as they would be in your inflation rate.
That's
if we
correct.
assume,
That's correct.
If we assume that both of those are 3%, then yes, those would, I mean,
Yeah,
there are other
correct.
factors, but those would essentially be equal, $372,000.
Yeah,
now
so
or
basically
$500,000.
372 would translate into 500 in terms of value.
Correct.
Right?
Correct.
Now I would say it's even more complex than this, because suppose you sell that, right, for 500, and then you think, okay, that's not too bad. But then the problem comes that the IRS, the Inland Revenue, would not take into account the inflation. And they would look, and then they would say, oh, you sold it with a profit of 128,000.
Yeah. And there is where you need the financial advisor.
Yeah, because then
And a tax advisor, because all of those things, I mean, we're talking about some basic principles and these equations and all of that.
That's
but
correct.
It's in all of those things where the details really come out.
Yeah. So essentially, what I wanted to say is just being at the inflation rate, actually, potentially you're even at a minus because of tax.
Right. And not to mention hassle, which is not really contemplated here, but owning stocks is usually less of a headache than or some other financial investment is usually less complicated than owning property.
Mm-hmm. Yeah. Thanks.
Yeah. All right, so let's look at some unless there are other questions, let's look at a couple of examples. So the first question is this: how much will something that costs $100 today cost 3 years from now, assuming that it appreciates at the rate of inflation? And then the second question is, what is the value today of an asset that will be worth $1 million 10 years from now, assuming that it will also appreciate at the rate of inflation, which we're saying is 3%. If we like, we can take a little bit of time and pause here and just see if we would like to maybe try this. I don't know if people have, I guess everyone has a phone or whatever, or a calculator, but maybe we could just stop here and and practice a bit. Does that sound okay? Any takers? So I don't know if anyone wants to share how far they managed to get on this, or if people are trying and would like me not to show that slide. Right, so I'll just move ahead and show the calculations of how this would work. So if we're talking about the first question, which is how much will something that cost $100 today cost 3 years from now, assuming that its price keeps pace with inflation, we would use the future value formula, which means we would multiply the present value times 1 plus the inflation rate in this case to the power of 3 because it's 3 years, which means we multiply 100 times 1.09, and we can expect that if its price keeps pace with inflation, it will cost $109 3 years from now. And then on the second one, what is the value today of something that will be worth $1 million 10 years from now? We use the other equation. We use the present value because that will bring us back to the present based on the known future value. And we do the same thing. And in that case, we divide by 1.03 to the power of 10. And we end up with $744,000. So that brings us to that amount. Let me ask if until here, things make sense. Anybody? Anybody? All right. I hope so. I hope so. So just kind of the last point that we want to make around this is that inflation rates, whether they are interest, all of these rates, whether it's inflation or interest, will compound over time. So they add on to each other, and then the next year they add on to, like Ravi said, the principal and the interest, and things keep increasing. And then the next year they increase, but they increase even more because they're increasing on the basis of a new and greater total. So when it comes to investments, and this I think is what can work in our favor or to our detriment. So when people invest, their exponential increases curve upwards, and you make more 1 year, and the next year you make even more, and the next year you make even more. But the other side of that same kind of double-edged sword is that when people are in debt, the opposite happens, that every year you end up paying more and more interest if you're not paying down the principal, and you just get further and further into debt. And this principle of exponential growth works in the favor of those who have assets and who have wealth and who are earning returns, and it works to the detriment of people who are borrowing money or who are in debt to other people. And I'll just show you a scenario, and later I'll share the Excel sheets that you can use to calculate these. So in both scenarios, someone starts with $100 dollars, and in one scenario, a person earns 6% interest, and the second scenario, 12% interest. And you can see that the results after 30 years are far more than double. So you think that, you know, one person is earning twice what the other person earns. It doesn't mean that you will have twice as much money. It means that over time, and after a certain point, that amount can be far more than double. And over time into the future, those amounts would continue to divaricate by even more and more and more, which is just the point of the power of those small percentage differences. So that brings us, I think, to the end of what we wanted to talk about today, which is that inflation reduces the value of cash over time, that inflation and interest compound exponentially. And next week, if you'd all like to come back, we'll talk more about exactly how that exponential growth happens and how those exponents work. And then the principle of the time value of money, which can be used to calculate the present value when we know the future value, or the future value when we know the value of something in the present. And then something that's going to, you know, the reason that we've gone back, I think, to this math is to understand that the principles of us calculating how we are investing our money and how we're saving that and where we're putting that are the three things that we've already seen. We've seen in the, let's say, the future value formula, we had the present value, we had the number of periods, and we had the rate of return. And it's those three pieces that are really going to help us understand how our wealth will increase over time, how much we put away, how long we put away for, which is usually determined by how soon in life we start investing, and then the rate of return that we're able to get, which, like Kazi said, might depend more on the amount of fees that we pay than it does on the return we're able to get from the market, because, like Kazi mentioned, the market is somewhat efficient, and beating it requires superhuman abilities. But more on that later. The point is to say that these equations, present value and future value, are the ones that we'll come back to as we look at how wealth grows, and also how we can predict that expenses might continue also to change in dollar value over time. And that is what I wanted to cover for today. I would really value any feedback and conversation and anything anyone has as inputs. It's tough for me to know whether this has been useful at all. So I'd really welcome feedback and input. Go ahead, Kazi, just
I
chime
just
in.
have a question. So thank you very much. It was very helpful. Made a lot of principles really clearer. The question was in terms of sorry, I can't remember now. Was it going to say? So I forgot. I'll have to get back to this. My bad. Sorry.
Okay.
Thanks a lot, Daniel. I think this was, a lot of these things, I think are things which was pretty much at the back of my mind, but seeing it all laid out probably brings stuff into more, what do they call it, more tangible. I'm one of those people who has property, and the value is, I bought it in so-called, seller's market, and now the value of the market has dropped in the country that I bought it. And some of those things you're talking about, the present value, the future value of the property based on the inflation, it's really hitting hard. But these are things which one makes decisions and one has to. I'm stuck with it. Now it's but it's good. I'm really glad to see this, and it was really, really useful for me. Thank you.
Okay, thanks, Ravi. Yeah, I kind of feel your pain about that. On the property, I also know something about that, and yeah, it's amazing. I think it's also interesting in property, small things that we wouldn't have expected can really change the value of that property by quite a bit. For example, a lot of people who own rental properties are really either suffering or making out like bandits now that there's COVID, and people's travel habits have really changed, but nobody saw that coming, and here we are. Anybody else? Someone is asking broad money versus base money. Kazi, go ahead and explain that question.
I just asked that question. So what I was talking about is when you talked about the fractional payment scheme, where 100% deposit kind of broke out, was that referring to the broad money supply or the base money supply?
Kazi, I'm not an economist, huh?
Okay, sorry, my bad. Okay, never mind. Never mind.
I'm
Okay.
sure it's a good question. I'm sure it's a good question, which I can't answer, but maybe someone else can.
I'll do my research. I'll get back to you. Thanks.
Yep. Okay. If there are no other questions or comments, listen, I'd really appreciate any feedback you have. I am sorry if this seemed like a math lesson, but I think that some of these points are important for us to review, especially as we move forward and try to look at how we can expect wealth to grow in various types of assets and investments and that type of thing. So if there's nothing else or no other comments, then we'll leave it here for now. And if you would like to return next week, I appreciate you letting me know yes or no. And if there's interest, we'll continue. Okay, thanks everyone. We'll stop here and talk to you again later, I hope. Bye-bye.